South African banks are going to fail, and in this video I'm going to explain to you why. But before I do, I first have to start with an analogy. Should you be worried if someone that you have never met, that lives in a different country, dies today? Of course not, unless they die because of a new disease. This is true not only for people, but for money as well. The modern global banking system is built on trust, and trust takes years to build, but can be destroyed very quickly. So when a large bank such as Credit Suisse, the second largest bank in Switzerland, the world's banking capital, starts to suffer, you should be concerned. This is because bank runs spread like a disease. Once trust in one bank has been lost, people start to question other institutions as well. This leads to people withdrawing capital, enforcing stricter lending conditions, and requiring premium collateral. The tightening of lending standards causes a positive feedback loop that once started is very difficult to stop. So when people think that the Federal Reserve or whatever central bank is in control because they can increase or decrease interest rates based on the demand in an economy, those people should realize that changes in interest rates take years to have an effect on the market, while trust can be destroyed very quickly. So why do banks fail in the first place? Although there can be a multitude of reasons, the short answer is leverage. When the bank receives a large deposit from a wealthy client, they pay that client interest for storing their money with that bank. But the bank does not just have this money lying around to be able to pay interest on that account. The bank must earn money. And they do this by taking the money from the deposits deposited at the bank and lending it out to other clients. They lend this money out with the condition that it must be paid back with interest. That interest income is then used to pay interest on the initial deposits and is used by the bank to pay expenses, employees, and make an income for their shareholders. In developed nations, there is a problem, however, because there is too much money in the banks. Too many depositors, but not enough lenders. What happens is the bank decides to lower lending standards and lower the interest requirements that must be paid back on the loans. This gives more people access to be able to loan money from the bank. This brings me to my next question. What happens when depositors realize that they can receive a better interest rate somewhere else? Those depositors start to withdraw their money from the bank, but the bank doesn't have their money because they are still waiting for the lenders to pay them back. The bank starts to struggle with cash flow, and then you have a bank run, where trust in the bank is lost and everyone wants to withdraw their money. This is exactly what happened to Credit Suisse. When the Federal Reserve started to hike interest rates and US Treasuries were giving a very good return on investment, why would people store their money with Credit Suisse when they can earn 5% on a one-year US Treasury bond? So clients of Credit Suisse started to withdraw their money en masse to go buy US Treasury bonds or to park their money somewhere else where they can receive a better interest on their capital. This is problematic for Credit Suisse because once again, they don't have the money and they're waiting for their lenders to pay them back. Now this is less of a concern for third world countries, and the reason is simple. Interest rates are not as low. Banks in South Africa charge high interest rates to people who want to loan money because there are many people who want to loan money but very few depositors. This makes lending standards very strict, where only the best lenders who can guarantee to pay back the money are able to loan money from the bank in the first place. And because interest rates are so high, South African banks can pay high interest on their deposits to keep their money in the bank instead of going to buy bonds from another country. This basically means that the cash flow of South African banks is much better because the leverage that South African banks take on is much lower. The risk to lend money in South Africa is a lot higher. So why do I think that South African banks are going to fail? The reason is simple. Today, we don't have an excluded financial zone. We have a global banking system. All banks are guaranteed from one another. They are all depositors of each other. I owe you, you owe me, Henry owes me, Henry owes you. We all work together. But this interconnectedness makes us all vulnerable. And when Credit Suisse starts to fail, we're going to wait and see other banks failing across the world. And this will lead to collateral shortages of South African banks. And those South African banks will eventually lose trust as well. And then we're going to see a bank run in South Africa.